Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Okay, so today we're going to talk about what it means to be part of IBC or understanding IBC or the infinite banking concept. Obviously, this was a book written by R. Nelson Nash called Becoming Your Own Banker, the Infinite Banking Concept. And I've studied this book and I've read it multiple times. We've done, I think we did a 28 episode podcast series on the infinite banking concept on the book itself. So there's a lot there. But what I really want to do today and what I'm finding is from my conversations with people when I'm training agents, when I'm meeting with clients, is that, can we boil it down and have an understanding of the process? And not the process of infinite banking itself, but understanding and be able to implement this idea that Mr. Nash had. Again, I've been doing it now since about 2006 is when I started my journey down the IBC pathway. And what I've learned is that we have to be able to take these things in order to get the proper outcome. And so what I mean by that is a lot of people want to start at the end. They don't want to start at the beginning. So let me just kind of lay this out and how I see it and how people that have successfully implemented this either through my clients, myself, other agents I watch and observe and appreciate and have a collaboration with. But they understand that first we have to understand, number one thing is the problem. What is the problem that we're trying to address? And that problem is that we finance everything we do. And what he means by that is that even when you pay cash, even if you go to the bank or if you finance it somewhere else, you're financing everything you do. And so the question is, who's controlling that banking function in your life? And I've done a number of podcasts on that. You can go back and look. It's called The Problem, which is separate from the series we did with Nicole Tate. Again, if you go to sagewealthstrategy.com, we have that. We have a drop down that's just BYOB, a series podcast on just becoming your own banker, where we talk specifically about the problem and go into a half-hour, 45-minute discussion just about what the problem is. But ultimately, it comes down to we finance everything you do, and you are in two businesses, like it or not. You're in the business that you're in today that you think about. Either you're running a grocery store, you're an employee of General Electric, whatever it might be. And the other side, the other business that you're in, unknowingly, most of us, is that we're in also the finance business. So again, the sooner we can understand that we're in the finance business, and then how do we take control of the finance business so we're profiting from that? Because right now, everything we do goes into somebody else, goes into some other corporate bank, and they're profiting from that because they understand how money works. So the job of this book is to help people understand how money works and how money flows, so we can help you and we can empower you to take control of that banking function in your life. So that's step number one, is understanding what the problem is. Step number two is wanting to change your position, wanting to get better, and wanting to say, I want something better than what I'm currently being fed. Because there's a ton of conditioned thinking that goes on out there. There's a ton of advertising, a ton of TV that is just designated to say the only place to put your money is Wall Street, right? So you look at the financial channels that are out there. There's just a ton of information that's being bombarded onto you, but rarely is it for your benefit. It's typically for somebody else's benefit, right? So we have to kind of take a step back and say, do we want help? And more than likely, if you're listening to this, if you're engaged in this, your hand is up saying, I want something different. I'm looking for something different because I'm tired of getting the same old results that I'm getting. So I would say that you're there. You're a person that says, I'm wanting to find something different. I want help getting out of the shackles and the rat race that is going on. I want to win the money game. But we just don't know how because we've never been taught the rules. That's one of the big things. So you're putting your hand up saying, help me. I'm open to new ideas and discussion. And that's ultimately the very first step of when people say, well, who's your client? I was like, those that are willing to learn and listen, right? Listen and learn. Maybe that's the better way is say someone that's willing to listen to what has to be said, learn, educate themselves. Those are my quote unquote ideal clients. The third step, so let me go back down. The first step is what's the problem, understanding and defining that. Wanting help is the second step. The third step is learning a process, right? How do we think about money, right? So this is a great question that I would ask people and say, what is it we want to accomplish? The infinite banking concept is truly a system. It's a process over a product at all. So it's the process of saying, well, if I use my money or I use any money whatsoever, I want to make sure I treat it with the utmost respect, if it's my money or anybody else's money, that it deserves. A great example of this is I could be walking down the street, and if I stop somebody and say, hey, you're going to buy a car, if you have $20,000 in the bank and you want to buy a car today, what is that? And you had the $20,000 in the bank earning 1% interest. You're a lucky person. And you say, hey, you can take that money, that $20,000 out of the bank to buy a car. How many people, honestly, if you think about it, how many people would say, I'd take that $20,000 out and I'd buy that car because I'm paying cash. That's what I was told to do. That was the best way to do it, is always pay cash. So what is your plan to pay it back? Would you pay that money back? And I can almost, and this comes from my experience, is that I would say 80 to 85% of the people that I ask that question is like, well, I don't necessarily want to pay it back. It's my money. Why should I pay it back? Right? So they consumed those dollars. Now, people that have wealth and businesses that have wealth understand that consuming those dollars and having no plan to pay it back turns us into that consumer mindset, versus somebody that has money and says, okay, we're going to put it to work. I'm a business person. We're putting it to work. Therefore, we got to charge principal and interest and get it refill that bucket so we can go do our next deal. The banks of the world, the J.P. Morgans and the Chases and all those banks understand that that's how you make money. That's what the Rockefellers do, right? That's that whole adage. What would the Rockefellers do? When you use your money, whatever it is, your money, somebody else's money, pay it back with principal and interest so you have a bigger pool of money for the next time you come around. So it's that thought. And then I would ask the question, I said, well, if somebody says, yeah, I think I would pay it back. Would you pay it back at 0% interest, 1% interest, because that's what you're earning? Or would you pay it back at 8 or 10% interest? Rarely do I ever find somebody who says, well, I'd pay it back at 8 or 10% interest. Those people that say that are those people that understand money. They understand business. And what I mean by that is they're saying, well, if I'm going to put my money to work, that $20,000 that I bought that car with, what's the real cost of that over my lifetime? Right? It's not just $20,000, but it's $20,000 plus the interest or plus the investments that you lost because you didn't have that $20,000 available for the next 30, 40, 50 years. This is what we call lost opportunity cost. And they understand that $20,000 can be $200,000 over their lifetime. So when they're putting it back, should they not be putting it back with that understanding that, hey, I want to put it back with more interest than it would have earned because now I have the ability to build a bigger bucket of money and now I can go do a bigger deal. I can do something, I can take advantage of chaos or opportunities. And a lot of times those things are tied together. So think about it from that. It's a system that we try to teach people that when you use money, put it back with principal and interest. And if you understand that and you run that through your own system, now it becomes your family financing system. This is how you start that legacy. This is what we want to do, is empower you to take advantage of that system to create this legacy. So now when your kids are going to college or they're buying businesses or whatever it might be, they understand the same concept. Putting the money to work, that's great. Charging a reasonable rate of interest on that. And again, this goes back in Nelson's book. He called it economic value added, EVA. So if I buy a rental property, or if I buy an investment property, and I don't charge myself interest for the use of that money, how do I evaluate if that's a good piece of property? How do I evaluate if I've truly made money on it? I'm cheating my family banking system, my family financing system, in order to subsidize my real estate. Well, what if I didn't pay the electric bill? What if I didn't pay the taxes? Then more than likely that investment's going to look fabulous because I have no expenses. Interest is an expense, even if you paid cash for it, because that piece of property needs to at least pay back an interest to your family financing system. You have two separate businesses there. One is the financing system, and one is the real estate property. So just have to distinguish that, and you want both of those to be profitable. And you help, by charging the right amount of interest, you help to determine if that real estate is getting you the returns that you need in order to take the risk that you're taking. So understand that that's the process that we're talking about. That's number 3 in the list, right? First is understanding the problem. Second one is, identifying that, hey, I want some help. I need some help changing what I've been taught and what I'm learning. Third is understanding the process that we're talking about. And number 4, quite frankly, comes into play. Once you understand those 3, number 4 has to come into play. Where do I store my money? Where am I putting my dollars so I can do those things that we just talked about? And so I'm going to throw out a couple numbers here. And the first number we're going to talk about is $24 billion. Now, this is as of today. You can go look these numbers up. It's on a government website. That's the amount of money that Bank of America holds in what we call properly structured whole life insurance. Properly structured life insurance. $24 billion. Wells Fargo, $20 billion. Right? Those are big numbers. Those are huge numbers. And these banks are holding that money there because it has certain characteristics. And I want to get into real quickly what those characteristics are. But there's got to be a reason, right? I've heard this said many times. Look at people that or organizations that have money. They leave clues. They leave clues to success. Not that I'm saying that Bank of America or Wells Fargo is successful, but the banking ideas are successful. They've mismanaged the whole thought process that, people call Wells Fargo and Bank of America crooks or, no goods or whatever it is. I'm not a big fan of them either, quite frankly. But the idea of banking says, where are the people that have money, where are they keeping their money? Not where they tell you to keep your money, but where are they keeping their money? I shared this one time. It's obviously somebody else's idea, but somebody would always say, and I love this line, is like, as the older I get, my eyes become better than my ears. I hear worse than I see anymore. And what I mean by that is I don't listen to what banks do. I look at what banks do. It's not so much what you're telling me, it's about what you're doing, when I see what you're doing. And I see it where they're putting their money. They report it on FDIC.gov. You can go look it up. It's a tier 1 asset. That's where they keep a good portion of their safe, secure money. And there's a reason why they do it. But what do they tell us to put our money? Put it in the market. Put it into our investments or whatever it might be. But why don't they put money there? Because it doesn't serve their purpose. Again, they've conditioned you to act a certain way, but they're acting some way different. So from that standpoint, let's talk about some of the ideal characteristics or ideal benefits of the perfect savings account. Because really what we're talking about is a savings account. And so it's important to understand that when you have a savings account, it has certain characteristics. First characteristic you want in an ideal savings account, tax-deferred growth. Man, everybody loves that idea. Let's have tax-deferred growth. So what does that mean? It means that we're going to pay taxes in the future. Now, I'm not always a big fan of tax-deferred growth because my belief is, are we going to pay higher taxes or lower taxes in the future, right? Hopefully I'm making more money in the future than I am today, so it's going to put me in a higher tax bracket. But we can talk about that as well. Tax-free distribution. Wow, that's even better, right? Tax-free is always better than tax-deferred. Competitive returns. Now, this is an interesting conversation because in Nelson's book, in the very introduction, he talks about that this is not an investment. This is not about rate of return. But I find it rather interesting because we're talking about where do banks save money, not where they invest money. Where do they save money? Tier 1 assets are safe, secure cash assets. So where are they saving their money? So where are we saving our money? And are we saving enough? That's the two questions that we should be asking. Are we getting a competitive return? We have to ask ourselves, competitive return compared to what? Let me say that again. Competitive return compared to what? And so when we look at it, if we can put our money in Wells Fargo savings account, are we getting anything even close to 1%? Even in today's higher interest rate environments, are we getting anything close to 1% on a very liquid, safe cash account? The answer is no. I talked to a gal the other day. She had $150,000 in her savings account, and she got a 1099 last year for $20. So there you are. Compared to what? But again, if we had a perfect account, that's what it would be. We want to be able to put a lot of money in. We have high contribution limits. That's the biggest thing. Is do we want to be limited by the government on how much money we can put away into something? The government puts limits on almost everything. So I'm not saying that it's not going to have it, but if we had the perfect asset, it would be we can put as much money as we possibly want into it. We want a deductible contribution, right? If we can deduct it from our taxes, even better. Collateral opportunities. So let's talk about that real quick. What does that mean? It means I can borrow against it. I don't have to stop compounding on my money. I can borrow against it. And so why is that important? Is because when you find opportunities to grow, to expand, to save your business, to expand your business, there's all kinds of stories. And I have clients that said access to their money during the pandemic was the thing that saved their business. They had to have access to money that wasn't correlated to the market. Same thing we heard in 2008. Same thing we heard in 2000. 2000, 2001, right? So all these opportunities and or salvation from chaos, they happen time and time again. It seems every 8 to 10 years, these things are happening. So the point is, you want collateral opportunities, be able to borrow against it. You want something that's safe. You can't have something that's correlated to the market, that's up and down, and you have no clue from day to day what it's worth. And people can change those values, right? So we have to have all no loss provisions. So again, this is the ideal account, right? No loss provisions. What does that mean? It's never going to go backwards. You're not going to lose unless you do something on your end to make it lose, right? So it's nothing out of your control is going to make it go back. We want to have a guaranteed loan option. That ties right in with a collateral opportunity. Just because you have a collateral opportunity doesn't mean that it's guaranteed that you can take a loan. One thing I'm going to talk about, and I'll show you some examples of that, but guaranteed loan options, that's a huge benefit because it guarantee means that you can get a loan against it. Unstructured loan repayments. Boy, that's another one we'll talk about. How powerful is it that you can determine when and how that loan gets paid back or that money gets paid back? You want to be an honest banker. You want to be honest with your business. But when times are tough, wouldn't it be nice to be able to change those repayment terms? That would be an ideal characteristics of an asset. Liquidity, use, and control. This kind of sums everything up. You want something that's liquid, and you can use it, and you have control over it. Not somebody else being the gatekeeper, right? I never want to be the gatekeeper. I want to empower people to be their own gatekeepers, because that's the real benefit, is that you're taking control, and so therefore we're empowering you to take control. But with that empowerment comes responsibility as well. So again, educating clients, have them understand what this means, and then having that asset. And so again, control, liquidity, and use of the money. There's some additional benefits, like just one simple one is if I'm working and I can't make my payments into that savings, if I get injured or disabled, is there somebody else that's going to be able to make that payment for me? Those are just other additional benefits that are out there. So these are just some key characteristics of the perfect asset. So what are assets might we be looking at that might fit into that, right? So let's take a look at that real quick. If we look at the perfect asset and somebody will say, hey, I'm doing something into a savings account, and that's going to be my perfect asset. And I'll look at that and I'll say, yep, you're perfectly right. It's safe. It's got no loss provisions because, the only loss provision might be inflation, but it's safe because, again, it's FDIC insured. We think that's super safe, right? We don't quite know what that means, but we think it's safe. And we can have a discussion of how it might not be safe, but that's a different conversation. The only other characteristic that ticks off on this list is that high contribution limits. So you can put as much money as you want into your savings account. It's safe, and there's no loss provisions. And you also have some liquidity, use, and control. So those are the four generally that I would say that you have when it comes to into a personal savings account. Is there tax-deferred growth? No. Tax-free distribution? No. Competitive returns? I would argue that's probably the least competitive returns. Can you deduct your contributions? Yeah, if that savings account is part of a 401k, maybe, but more than likely it's not going to be. Collateral opportunities? You might be able to collateralize your savings account, maybe a CD. Some banks, my grandpa used to do that back in the day, so I'll give it that. Unstructured loan repayments, you can do that as well. Guaranteed loan options? No, there's nothing saying that anybody has to borrow you money against that CD or savings account. So let's look at the one that I get a lot of. I'm going to do this with real estate. I'm going to put my money into real estate because that's where I've been told that I can do this. Now, I love real estate. I think it's a great option, but that is more of an investment. This is what we're talking about today is savings. Tax-deferred growth, definitely get that with real estate. Is it tax-free distribution? Maybe, maybe not. Competitive returns, again, real estate is, but the HELOC is not necessarily competitive return. High contributions, again, you don't contribute to what your home equity line of credit is. That's determined by the market. Collateral opportunities. Definitely have collateral opportunities with the HELOC. It collateralizes that property, that investment property, or your home property, so they take a collateral position against that. So what does that mean is if you default or die, they get access to your home's value before anybody in your family does. Is it safe? Ask people in 2008 if it was safe to have $1 million property that basically overnight went from $1 million to $300,000, and they had a huge line of credit, or they didn't take their line of credit, that was gone. So I'm going to say it's not safe. No loss provisions? Absolutely not. Guaranteed loan options. This is the one that I think most people have the biggest misunderstanding about. If you have $700,000 of equity in a property, are you guaranteed that you can get access to that? Let me ask that question one more time. If you have equity built up in a property and you want to go take advantage of an opportunity, or maybe times are tough and you need access to it, can you get access to that equity in that property? I'm here to tell you that the answer is no. I've had people argue this with me, and I've told them, I said, remember 2008? Wells Fargo pulled everybody's equity line of credit. How do I know that? Because they pulled mine. We saw that again in 2021, I believe it was. Maybe it was the first part of 2022. Wells Fargo says, hey, we're going to pull these lines of credit. There's nothing saying that they have to give you a loan against your property. They decide, so therefore they're in control. So again, I've had people say, well, if you have good credit, nobody's ever pulled a line of credit. When you have a credit score of 780, great job, and everything's going well, and Wells Fargo pulls everybody's line of credit. It doesn't matter what that is. They pulled their line of credit in 2008, and they're doing it more and more. Banks are doing this more and more because there's uncertainty. When there's uncertainty, banks are pulling their arms in. They don't want these open-ended lines of credit. So, because they don't know where that equity of those housing is going, especially with interest rates rising. So think about that. There's not a guaranteed loan option in a HELOC, even though there's a lot of people think that there is. They don't have to give you that loan. And then the next point is, structured or unstructured, you have to pay back. Absolutely structured. You take a loan from the bank, HELOC or whatever, no matter what's going on in your life, come the first of the month or whenever you set up that date, pay me. The next month, no matter what's going on, what are they going to say? Pay me. Right? You have to pay them. Pay me. It's not your terms. It's not an unstructured loan repayments, right? It is very structured, and it's always to their benefit. And do you have liquidity, use, and control? Not really. You have to go through a process. You have to go through a loan process in order to get it. And then they might not keep it, or then they set terms if you can actually apply it. And there's really no additional benefits to that. So what is the thing that clicks off the most of these benefits? Let's go into the permanent life insurance. Again, I'm going back to Bank of America. Why does Bank of America keep $24 billion in their Tier 1 assets in properly structured life insurance? This is called bank-owned life insurance, or BOLI. They actually have a name for it, a separate division for it. Bank-owned life insurance. So banks own tons of these products. Right? I'm just picking on one. Bank of America, $24 billion. They have another division, it's the same thing, but they call it COLI, right? Corporate-owned life insurance. The Walmarts and Pfizer's and all these big corporations have tons of money in this properly structured life insurance. And why? Because it hits all these benefits. Now, what have we been taught to think? Oh, life insurance is a terrible investment. Don't put your money there. Well, let's think about why that's being said. It's because they think of it as an investment. I think of it as a savings vehicle. Once we have our money in our savings vehicle and we have an opportunity to invest, I say, absolutely, let's go for it. And then let's use a collateral opportunity with our life insurance to go do that. So just be careful when you hear that on the street, because again, why are we conditioned to think a certain way? Because, there's just a lot of noise out there that wants you to think a certain way. So look at the benefits. Look at what the people of wealth, look at the companies and the banks that have the ton of money. Where are they putting their money? Properly structured life insurance. Where are they telling you to put your money? Put it in their savings or in their investments. But here it has all the different benefits. Tax-deferred growth definitely is. If you go out 30 years and you put money in there and then eventually one day you go, hey, I'm just going to surrender this. Fine. Then when you pull it out, any growth in that's going to be taxed. Now, if you die or you never take it out, or you use a policy loan, then those are going to be tax-free distributions. Competitive returns. Again, remember, compared to what? Compared to that savings account. Because we have to compare like animals to like animals. High contribution limits. It's almost unlimited up to the point of what the insurance company will allow you to get in coverage. So you have very high contribution limits, not set by the government, but set by the insurance companies that are mutually owned. Again, what is a mutually owned insurance company? Ran for your benefit. So they're setting those limits. Deductible contributions. Nope. Life insurance doesn't have deductible contributions. Maybe in some circumstances we do, but 95% of the time we don't want it to be deductible. Why? Because if you deduct the seed, they're going to tax the harvest. If we deduct the seed, they're going to tax the harvest. Collateral opportunities. Definitely can use this. Banks will love. I have farming clients that will use their policies all the time to go in and get a very low interest rate loan from the local bank in order to take it an operating loan or whatever it might be. Banks love the ability to take life insurance as collateral. Is it safe? Absolutely safe. Once money's in these policies, unless you're doing something on the outside, they never go backwards. Insurance companies have been around for over 200 years. And the point is, there hasn't been a life insurance company that has ever refused to, or been unable to pay a claim. So think about this from the standpoint of how safe is this compared to banks. It is extremely more safe than working with banks, and it has no loss provisions. Again, your account, if you're using properly structured life insurance, the account never goes backwards. Unlike all the other products that are out there that have the opportunity to go backwards. Guaranteed loan provisions. This is huge. In the contract language itself, it gives you the first right to borrow money from the insurance company. Insurance companies hold tons and tons and tons of money, and they borrow money to corporations through bonds, or they buy real estate, or they do mortgages. They even lend money or assets to banks because banks have to shore up their balance sheets. So they're the lender of the banks. So you think about it that way. But you're the first person in line. If you want a policy loan, they can't refuse it. And then once you take a policy loan, it's up to you to determine when and how to pay it back. Now again, when we're empowering you to take control of the banking function in your life, and so therefore, the responsibility falls on you now to set up a structure. Make sure that your family financing system is just as healthy as any other part of your businesses. Liquidity, use, and control. Absolutely. And then there's some additional benefits. One would be a thing called a death benefit. We haven't talked about a death benefit yet, but here's where the additional benefits come in. You die, your family now got that loan paid off, plus they have other money, other death benefit proceeds, that liquidity to help run your business, to help keep your business afloat until you can find somebody else to help run it. Liquidity to buy out your siblings or whatever it might be. The additional benefits, the death benefit that provides your spouse with the ability to stay home with the kids in the time of mourning. There's just a ton of benefits that come with that extra thing called a death benefit. But what we're doing in the meantime, we're borrowing against the cash value of the contract all throughout our lives until the point where we die. We graduate from this world, we know that we're going to leave more money than what we have borrowed against it. Now, how much more? That's a topic for discussion. How much you can borrow? There's a lot of things that fall into that. But that's another additional benefit that we can talk about. So think about that, is that this is the reason why banks and corporations use money. They understand the product. Now, so let me just go through the 4 steps, right? So and I would even say there's a 5th step I'm going to throw out there right now, but we're not going to go into it, is once you have that account set up and you have the availability of money, then it's like, let's take that money and let's put it to work, the implementation, right? So, and I have a couple podcasts that talk about how money like water has to flow. So I'd encourage you to go back and listen to those podcasts as well. But that's the next step, is like, we've built this reserve. We have this bucket of money. Now, what are we going to do with it? Are we putting it to work? Are we content with just having it be safe, secure, liquid money and able to use it certain things? So that would be probably step number 5. But the 4 steps to building and understanding and being successful in the infinite banking concept is A, understanding what the problem is, because what are we trying to solve? B, raising your hand and say, hey, I want help. I want something different. I'm looking for a better way, right? Number 3 comes along is like understanding that there's a process. It's not anything else. It's the process of how we think about money. And the 4th is, what's the tool that we use in that process? And the 4th, in which we spent some time on today, was looking at what people of wealth and corporations that have a lot of wealth, where do they hold their money? Your wealth has to reside somewhere. Why not reside in an asset that has all these characteristics that you control? So if you're looking for more information on this, have a deeper discussion, reach out to me, Wade at sagewealthstrategy.com. Hop on the website, schedule a meeting. We'd love to have conversations around how we can build one of these for you. And this is going to be life-changing. This is going to be, you're going to make a change over a lifetime, your lifetime, hopefully into the next generation, because ultimately that's what we want to do. Get ourselves out of bondage from the current financing system that we're in. And then once we learn and understand that, then bring the next generation along as well. So again, I'm all about empowering people to making a better life for themselves, as well as making it simple and fun, and have an understanding that we don't have to be relegated to what the bank tells us to do. Right? We want to be in control of that function, because the person that controls the financing in your business and your life is the person that's truly in control. So take control of your banking system and then apply these principles. Thank you. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches, and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.